Thank you very much. It's a great pleasure to be here back in Hayes today. I always enjoy coming up here. I have a copy of our Ellis County Housing Outlook that's on your table there today. And I also wanted to just mention that we do have copies. We do a larger forecast of the larger markets across the state, including Kansas City, Lawrence, Manhattan, Topeka, Wichita. And if those are of interest to you, there are copies of those over there on the bar next to where you had your drinks. So please feel free to take those. They are here for you to have and make use of it if that's useful to you. So I'm here to talk about our housing outlook. And when I do an annual housing forecast, I need to make an acknowledgement first. First acknowledgement I need to make is a special thanks to the Kansas Association of Realtors and to all of the realtor boards across the state, including the Hayes Board of Realtors. We now, for about 13 years, have had a contract with the Kansas Association of Realtors where we access all of the multiple listing services across the state. We then make them all talk to each other so that we can provide monthly housing statistics that would not be available otherwise. And part of that then provides those reports back to the Hayes Board of Realtors. And so when you see monthly reports that come out about what has happening in Ellis County or in Hayes, that comes through that partnership that we have with the Kansas Association. We're very grateful for that. So also, Jeremy has posted my slides on the Center for Economic Development Business Research website, but you can also get them on the Center for Real Estate website. Unlike Jeremy, I'm not fancy with QR codes, so don't go and point your phone at this. I will not be held accountable for whatever it takes you to on your phone. But if you go to wichita.edu/real estate, you'll see a link right there on the home page that has the presentation today. And so when I do my annual housing forecast, I look at two broad fundamentals to say what will we see in housing markets going forward. And one of those is the labor market. How are people feeling in terms of their job situation, in terms of their likelihood of keeping their job, of wages growing, and so forth. And as you heard from Jeremy earlier, the employment situation is very, very strong. There's nothing about that side of the economy that I have any concerns about in terms of causing a downturn in housing markets. Okay? Demand, because of the employment situation for housing, should be strong across Kansas over the coming year. So the other side of it, and that's what's going to happen, is looking at mortgage markets and financing, because very few people have the capacity to buy a house without getting a mortgage. And so, as you are all very well aware, we have had a very dramatic and steep increase in mortgage rates. Mortgage Makers Association actually just released their latest weekly figures today, and it is 7.68% is where the 30-year fixed mortgage rate averaged over the past week. For a lot of us, this is just kind of really a shock to the system. It's like going and jumping into a swimming pool full of ice cubes, right? We have been addicted to ultra-low mortgage rates for almost 15 years now. But we need to keep in mind that what we have had since the financial crisis, going back here since 2008, 2009, the Federal Reserve has been heavily involved in mortgage markets directly by buying mortgage-backed securities. And so the environment that we've been in, the technical term I've used in past years has been a funky financial markets, but it's certainly been abnormal. It's not been usual. And so if you look at where mortgage rates are right now, they're actually right in the same ballpark as where they were prior to the financial crisis back in 2006, 2005. And that was a time, if you recall, that housing markets were on fire, right? And so there is an element of acclimation that we have to deal with here, but we are not really outside the range of normal. This is what was outside the range of normal. So with our forecast going forward then, we need to think not about where we are today, but where we think we'll be in the coming year with mortgage rates. And my belief is that there is a lot more potential for mortgage rates to fall from where they are than there is for them to increase. That Mortgage Bankers Association release today said mortgage rates headed towards 8%. And I just thought, who on earth wrote that headline? Because it creates this impression that somehow we're going to go above 8% higher. I will be very surprised if the 30-year fixed mortgage rate goes above 8%, it hits 8%. And as I said, I think it's much more likely that they'll go down in the coming months. So what are the things that go into that? And why is that what I believe? Well, the first is that one of the things that would cause mortgage rates to go really, really high would be if inflation really became embedded and that financial markets expected that inflation was going to continue in the future. When you go back historically, you go back into the late 70s and early 80s, that's when we had those really high mortgage rates, that was because of this embedded inflation that the Federal Reserve had to work for almost a decade to really get back down and under control, okay? When that happens, if that happens, we should expect to see mortgage rates go up significantly from where they are. But if you look on here, the red line is a
survey by the University of Michigan. I think we've lost this entirely, so I'm just going to abandon it. Can you all hear me okay? Good. Sometimes when I'm teaching, sometimes I'll end up in a small classroom, and I'll just go without it. I'll go without it. I'll end up in a small classroom, and occasionally I'll get really animated, I'll get really excited, and I'll start talking really loud. And one time I had a student go back to class like that, and she just put her hands up. So I think I can manage here, but if you can't hear me or if you don't understand something, please ask. So that red line is a survey by the University of Michigan of households asking them, what do you think inflation will be over the coming year? And that's a forward-looking measure of inflation, in contrast to the blue line, which is just the headline CPI inflation. It's what was it over the past year. But I really want to focus our attention on the green line at the bottom. And if you were here with us last year, I talked about this measure. It's called the 5-year break-even rate. And what it does is it looks at two different types of treasury securities. Federal government securities, where they borrow money for 5 years. Traditional treasury securities, they're just nominal interest rates that are paid, and you pay back the principal balance at maturity. But there's another type of treasury security called a TIPS security. Treasury Inflation Protected Security, TIPS. And those TIPS bonds are securities where on the back end, investors are compensated for actual inflation that occurred over the prior year. And so those securities, because you get protected from inflation on the back end, they don't have to have as high of an interest rate to compensate investors for inflation moving forward. What's important about that is that the difference in interest rate between the regular treasury security and the TIPS gives us a direct measure of what financial markets believe inflation will be over the coming 5 years. It's like the Vegas line for the Chiefs game. You've got people betting money on both sides of it, and it then reflects the collective wisdom of the financial market. Sorry, I'm way out in western Kansas. I know some of you are Broncos fans. I'm really sorry for you. So my point here with this 5-year break-even rate is that is suggesting that investors who are putting literally hundreds of billions of dollars on the line are expecting that inflation will average 2.2% over the next 5 years. That is within the range of the Fed's inflation target of 2%. Now, how we get down from where we are to that 2.2% level and average out, there's a lot of different paths we could take. But the point is that right now, financial markets are saying, no, we think that the Fed is going to get inflation under control and that that's going to be low. So that's not putting upward pressure on interest rates right now due to high expected inflation. Does that make sense? Okay. The second piece that goes into this is the baseline rate of the 10-year Treasury. So the red line on this graph is the 10-year Treasury interest rate, and the blue line is the 30-year fixed mortgage rate. And one of the things that you'll notice is that these two are highly correlated. When the 10-year Treasury rate goes up, the mortgage rate goes up. When the 10-year Treasury falls, the mortgage rate falls. One of the things that's really been driving up the mortgage rates over the last couple of months has been this increase in the 10-year Treasury rate over these last several weeks. And that's something that is a little bit puzzling to me. There are a lot of stories that are going around. Is this concern about, the federal deficit situation, and are investors less willing to hold U.S. Treasury securities? There are lots of different articles that you can read in the Wall Street Journal and in other press talking about what's been happening with Treasury rates here. But the only way that they would go up a lot more from where they are now is if we had higher inflation moving forward. Okay? And so I tend to believe we're about back at a normal level of the 10-year Treasury compared to, again, where we were back in the early 2000s, at a time when we had low inflation, solid economic growth, and nothing funky going on in financial markets. I think we're back to normal. I will note that there are some economists, very notable economists, Paul Krugman, Nobel Prize winner, columnist with the New York Times now, he actually believes that that 10-year Treasury in the 2% range is much more likely to persist. And his argument for that is primarily tied towards lower demographics and lower birth rates. That when we have low growth in that side, that holds down this real interest rate. So his view is that the Treasury rate probably ought to come down from where it is. Mine is that we're probably about where we ought to be. In any event, I don't see us having a big increase in that 10-year Treasury unless there's something else big that changes from where we are. So then that leads to the third element of what's going on with mortgage rates. And that's the green line at the bottom here, which is essentially the risk premium or the added interest rate that people like you and I pay for mortgages compared to what the federal government has to borrow over 10 years. And you can tell that most of the period of time, this goes all the way back to 1985, that mortgage risk premium is below 2%. In fact, it averages about 1.7% over this entire period of time. There have been a couple of points in time. You go back to 1986. You go back to 2009 and 2008. Go back to 2020. There have been a couple of periods of time when that mortgage risk premium went up. Right now, it is at one of the highest points that it has been in a long time, ever. Okay? I don't know why the mortgage risk premium is as high as it is right now. It's almost 3%. Okay? But if it came back down to 2%, that would give us room to have mortgage rates fall from, what did I say it was today, 7.6% down to 6.6% with no underlying change in the 10-year Treasury security. And that is really where I believe, if you look at what that mortgage risk premium, what times that it's gotten really high, it's been relatively temporary. Okay? It's come back down to that long-term average and then stayed at that long-term average. And so that's why I tend to believe that we have a much better chance to see mortgage rates fall over the coming year than we do to see them increase over the coming year. Does that make sense? Any questions on that before I move on? Okay. So with that, I'm not the only one who thinks mortgage rates are going to fall over the coming year. The Mortgage Bankers Association's forecast actually is to fall below just a little over 5% over the next year. National Association of Realtors is down to 6%. I think 6.5% would be more reasonable, but I haven't run the numbers the way they have. And so they've got a lot more formal analysis behind it than just my, back of the envelope, quick little guess that I made. But if that's the case, mortgage markets shouldn't be the same hindrance to housing markets over the coming year that they have been over the past year. Okay? That rapid increase in mortgage rates clearly created a very sharp decline in home sales activity across the state. Not nearly as bad in Hayes as it has been in other parts of the state, but still, demand has clearly softened because of that rising mortgage rates. But with employment strong, and if mortgage rates do fall, albeit not to the ultra-low levels that we had before, and the last piece of it, as households begin to adapt and acclimate to the mortgage rate environment that's really more consistent with normal, I think that financial markets are also going to suggest that that's going to be a strong element in terms of demand for housing. Okay? There's nothing that's causing housing demand to drop off any further. And so the question is, why have we seen housing sales drop so low? Actually, our forecast for the state as a whole is, we've seen this big drop this year, and that's reflected in that 12.4% decline. Our forecast for next year is home sales activity will be flat. So why, the question you should be wondering is, if you're saying that labor markets are strong and mortgage markets are going to increase demand over the coming year, then why aren't you predicting home sales activity to increase? And the answer to that is the lack of inventory. And this is something that has been true across the state. Indeed, it's true across most of the country. And we'll talk about why in a little bit. But there are several measures that I want to give. This is the number of active listings in Ellis County by month, according to the Hayes Multiple Listing Service. And the red line is the moving average. And you can see that there was a big increase in active listings as you went into 2016, 17, and 18. But then it came down very, very dramatically. But a better way of thinking about this is thinking about the balance in the market. And so one of the ways we measure the balance between supply and demand is through a number we call months supply. We take the number of active listings, how many homes are available for sale, and we divide it by the average pace of sales over the prior year. So for instance, if you've got 100 homes on the market and you're selling 20 homes a month, then you have 100 divided by 20, a 5-month supply of homes available. Our rule of thumb is that a balanced market is one where you have between a 4 and 6 month supply of homes available. That's a market where you have inventory that buyers can look at, but not so much that they just, it's overly flush and that they can start really dictating terms in the negotiation. When you have more than a 6-month supply, we begin to question, is this becoming a buyer's market? If we have less than a 4-month supply, we begin to question whether it's a seller's market. Now, I should say, this is just a rule of thumb. It's not anything magical. Buyers and sellers actually have to behave like it's a buyer's market or seller's market, and they don't really care what the statistical numbers are. They just care how they feel about what's available, what's on offer, and what are their opportunities there. Well, as you can see, Kansas as a whole, we've been in this seller's market threshold going back to 2015, and month supply was very, very low. We got down to a point of month supply in Ellis County of about a 2-month supply during the height of the post-pandemic boom. That was really, really tight inventory. It's come up a little bit here in recent months, but it's still a relatively tight inventory of homes available for sale. Couple of other measures that we can look at to try and say, is it leaning more towards a seller's market the way that I think that it probably is? Well, one of them is to ask, what percentage of homes are selling at a premium, either at or above the original list price? Because the normal way we think of these real estate transactions is, I put my house on the market for $200,000. Usually we expect the buyer to offer something less than the list price. Oh, well, I'll offer you $190,000. We negotiate, we come in at $195,000. That's sold at a 2.5% discount compared to the original listing price. Well, normally you can see here in Ellis County, you'd sit with less than 20% of all homes would either sell at the original list price or above it. But since the pandemic hit and those inventories got so tight, all of a sudden now you're sitting where you have about 40% of all homes that are selling at a price at or above. That's an indication to me of a seller's market. I don't want to try and lowball the seller, because if I do, I may lose out on this deal, okay? And in many instances, it's not just at that price, it's you put it on the market for $200,000, I'll say, well, here, you know what, Alan, take $205,000. Let me see if I can give you a little bit more. You know, and why would I do that? When you're in multiple offer situations, which can happen for attractive homes. As you would expect, when we're in a situation where we have very tight inventories, demand that still remains strong, if muted compared to where it's been in the last year, we've continued to see home price appreciation. This is the median sale prices of homes in Ellis County going back all the way to 2007. And you can see it's gone up from what was just a little over $100,000 back in 2007 up to now where it's pushing $200,000 now. That is, remember, the median sale price is the price at which half of all the homes that sell for more than that, half sell for less, okay? The challenge with the median sale price is that it doesn't necessarily capture the composition or what types of homes sell in the market. So imagine if all of a sudden we had a whole bunch of homes that sold here in Hayes that were all very, very small, older homes, and they all sold for $100,000, okay? And we had 50 of them sell this month. That would cause the median sale price, half of them sold for more, half for less, to fall down to $100,000. That would not mean going down to $100,000 from $200,000. That would not mean that everybody's housing values fell by 50%. It just meant that a different type of home was selling right now. So we'd like to have a home price index that really controls for the quality, which homes are selling. We don't have that specifically for Hayes right now, but there is an index put together by the Federal Housing Finance Agency that includes all of the counties in Kansas that are outside of the 5 large metropolitan areas, okay? So Ellis County is included here, but so is Seward County, so is Clay County, so is Crawford County down in the southeast, all over the state. The point that I really want you to take away from this is that this rapid appreciation we saw statewide, average home prices increased by 17% a year ago, and over the past year, it's still about a 7% increase compared to the prior year. But that increase was not a big city phenomenon. Sometimes what happens in Wichita or in Kansas City sort of dwarfs everything else in the state. And as a result, when you go and you look at the non-metropolitan areas, it's a totally different picture. That has not been the case over the last couple of years. Home prices on average in rural Kansas over the last a year ago were up 15% compared to the prior year. And this year, latest data we have, second quarter, up about 7% compared to the prior year. So our forecast is that home price appreciation is slowing. We expect that Kansas home prices will end the year up about 5.5%, and then end next year up another 3.5%. Now there's one thing I want to go back to the previous picture and just highlight. When you see these lines going down, right? The home price appreciation number is going down, right? That's what's happening here in the most recent months. That does not mean home prices are falling. The zero line, this big black line here, that is the point where if you're above it, home prices are appreciating. If you're below it, home prices are falling. So all that's happening here is that we are going from this really, really crazy, absurd appreciation rates that we've never seen in Kansas previously, back down to what are more typical, normal appreciation rates for Kansas. And again, that's really what our forecast is projecting going forward. So what has caused the supply shortages that we have? This is single-family permitting activity across the state of Kansas. And it goes back all the way to 1990. And what I want you to notice here is that following the financial crisis back in 2000, really 2006 was the peak for new home construction. New home construction just plummeted. And we just barely got back to where we were back in the early 1990s in terms of new home construction. This is not news to any of you in Hayes because it's been an issue that we've talked about here for more than a decade, and I'm sure you were talking about it longer than that, of how do we build new homes. I have to tell you, you all have somehow captured magic in a bottle here with your ability to add new homes and the new construction that you've had going on here over the last couple of years. And to do it at a price point that actually meets that middle part of the market where the shortages are most acute. And so you've accomplished something really, really special here, and that will help bring some more balance to the market more quickly than it's going to come to many parts of the state. Our forecast for new home construction going forward, this year, new home construction was hammered even harder than existing homes with that increase in mortgage rates. And it's the buyers in that middle segment. For a lot of the states, $350,000 is about the lowest price point that you can build a new home of any meaningful quality, okay? And buyers in that $350,000 to $500,000 price point, they were perhaps affected more severely by the increase in mortgage rates than any other price segment. A lot of the new home construction that's been going on across the state right now has been at much higher price points. They're these custom homes, and a lot of those buyers, maybe all cash, they don't need to get a loan, or if they do need to get a loan, the higher mortgage rates just don't affect them as much. But those lower price point homes, how do you call a $350,000 home a lower price point? Those are the ones that have struggled the most. And again, that's where I say what you've accomplished here in Hayes, I think is just really, really tremendous and exciting. Our forecast is a slight increase in new home construction next year. That's predicated on mortgage rates falling. If mortgage rates don't fall like I think they will, then I would expect new home construction to be flat at best next year. And so that is the sum total of our forecast. I think I've got 1 minute left to answer questions. So if you have any questions, I'm happy to answer. Yeah.
Last year, maybe the year before, you said we're still 12 years behind in construction?
Yeah.
Still hold true?
Yeah, what I think I said last year is that it was about 12 years of that new home construction that was so low following the financial crisis. So I was talking about this period of time. I don't know, I couldn't give you a specific number to say, we need this many years of construction to get out of problem. But I would say, it took us this long to get to the short inventories that we have today. And I had a friend who once told me, when you walk 3 miles into the forest and you're lost and you don't know what to do, turning around is a good first step, but you can't expect that turning around you're going to be out of the forest. It's going to take 3 miles to walk back out of it. And so it shouldn't be this isn't something that is going to resolve itself quickly or immediately. It's going to be something that we have to really look at a lot of different avenues to fill in and deal with the inventory shortages that we have. Obviously, Hayes is ahead of the game in terms of some of that. I would say one of the areas, if this is my little pet project now that I have, I think new home buyers today very rarely are doing let's buy a home that needs some TLC, let's build in sweat equity, and then we'll sell it in a few years and move up to the home we want to move into. First-time buyers are wanting the home that's the pristine HGTV finished home immediately. Do we need to go back and add home renovation classes into high schools and things so that kids really learn, no, this is the right way to do it? That would make a difference too if we could take some of our older housing stock that maybe is run down, maybe needs some additions, maybe needs some work done to it, but has good bones and it could function for us. Renovate that, upgrade it, and make that a better part of the housing stock. That could also help resolve some of our inventory issues. And now I am a minute and a half over my time. So I will pass it on, and I'll try to stay towards the end and answer more questions.